All right, everyone, welcome to our next part in our video series. It's Serge Berger here. Before we get started, I do want to do a quick audio and video check. Yeah, sounds like you guys can hear me. Yes. You can also see the screen, right? Perfect. Okay. Okay, so this is now the continuation in our webinar series. What we are talking about now in this webinar today is we're going to start looking at technical analysis, and so this is, of course, a very extensive topic, and we have to break this down into different parts. So today, being the first part of this, we are going to take it very slowly. We're going to talk about the basics of it, and all how it relates to stock, specifically the stock market. Because technical analysis, as you'll see in just a minute, we can use it in any time frame, and we can use it in any asset class. But different asset classes lend themselves better for technical analysis in various time frames. So when I show you how this works in the stock market, I'm going to show you how it works in the various time frames. Because really, in the stock market, technical analysis works in all different time frames. So that's the very good news about that, as you'll see in just a minute. Okay, so that's the topic for today. We're going to talk about technical analysis part 1, as this relates to the stock market. But before we get into that, I should say, let's just quickly review just a couple of points that we went through over the first 2 or 3 webinars or so of the series. Number 1, just quickly lay it out, the stock market, U.S. stock market is a very large part of the global equity market. So you can see the U.S. stock market makes up more than 60% of all the other countries combined in the developed world. U.S. stocks are good to trade in general because there's a lot of liquidity. Market capitalization is something that you want to take into consideration by the type of stocks you trade. I think mid and large cap stocks and some small cap stocks are best to trade. So that's the calculation for market capitalization. It's stock price multiplied by outstanding shares, a quick sort of formula that we went through last time. And we talked about the different categories: large cap, mid cap, small cap, like I just mentioned. Blue chip stocks, growth stocks, value stocks, penny stocks, all these kind of stocks are available. Various interesting sectors to focus on: banking stocks, technology sector is very interesting. Consumer-oriented stocks that we all know, like McDonald's and names like that, or Nike, names that most people are familiar with, are usually good stocks to trade. Stocks in the news, there's a couple of websites here that I discussed last time that are good to look at for news specific to U.S. equity markets. Liquidity, we just talked about before. I usually like to focus on stocks that are trading at least 500,000 shares or more each day. So to me, liquidity is very, very important. We talked about the different sectors and groups. That was the last seminar we did, or the last webinar we did, which basically talked about the different sectors, specifically, in the S&P 500. Then we have different industry groups as well: transports and retail stocks, and so on and so forth. We touched on it a little bit last time, and that's technical analysis, and that's really the point here that I want to make today. So technical analysis is again, like I said before, is a very large topic, and it's something that we will talk about in great detail to the extent possible in this webinar series. But the good thing about the U.S. stock market is that there is a lot of liquidity and there's enough volatility, but most of the time there's not too much volatility. So technical analysis actually works very, very well, particularly from a swing trading perspective, and it works intraday as well. You can also day trade it, of course. Personally, I'm more of a swing trader. I like to hold stocks for a few days, a few weeks, sometimes a few months, and take part in some very large and good moves, up or down. So technical analysis works very well in the US stock market. You have plenty of volatility, not too much orderly information flow. In other words, you know when various types of stock companies report their earnings. You know when the economic data comes out. So there's not a whole lot of surprises, outside of geopolitical risk and potentially here and there some corporate announcements that come out. But for the most part, from a news flow perspective, the U.S. stock market is nicely constructed, and that is really good for technical analysis. So we talked about this slide. We'll get to that a little bit later. Sectors and groups. We talked about the 11 sectors in the S&P 500. Really, it's only 9 of them that you want to focus on because 2 of them, with being telecommunications and real estate, don't really have any exchange traded funds or can't really be looked at as a group enough because they're kind of too small still. The sectors is sort of the next version down. You can see here the consumer discretionary sector is divided up into various parts. And all of this, makes for a very orderly and well-organized market in the sense that you can have a good overview of it. You have seasonal patterns, cyclical patterns, and so on and so forth. And these are all things that in my opinion are make for a very good orderly market. So let's see here. Let's continue on, and these are just for reference points, and this is going to be interesting as well for today's presentation to remember to remember these exchange traded funds of the sectors of the S&P 500, and you can see, like I said before, telecom and real estate are not part of this. All right, so let's talk about technical analysis, and I want you to read and think about this for just one moment. I'm going to go on silence for just one moment, and if you don't mind, I would like you to just kind of read this and think it through for a minute, what this is actually telling you, what technical analysis actually is, because a lot of people may think they know what it is, but really, when it comes down to it, it's really, you have to have a little bit of perspective on it. Okay, so as you can see, what technical analysis really is a methodology for forecasting the direction of prices using the study of past market data, primarily being price and volume. So again, my focus today is to show you how stocks can very nicely be traded using technical analysis. Technical analysis, of course, is different from fundamental analysis or other types of analysis, which of course you can use as well to trade stocks. I find that after nearly 20 years as a trader, I find that technical analysis gives us the best and the truest read or the truest picture of price action and the best opportunities, because it doesn't focus on fundamental data, which can take much longer to start working, and it's not based on so much sentimental stuff, investor sentiment stuff as well, which also can take a long time. So technical analysis is really something that you have to believe that the price action is more important than anything else. And I'm going to show you guys many examples today and the next few webinars that are focusing on technical analysis, where I'll show you how technical analysis has over time, over and over again, and continues to do so, forecast big important moves in the stock market, in this case particularly the US stock market, and given very good trade ideas. So that's going to be what I want to focus on today, beyond giving you a little bit of the basics here in just a minute. Like I said before, technical analysis works very well in all major asset classes. The major asset classes, for the most part, are considered stocks, bonds, currencies, and commodities. Like I said, they work in all different time frames as well. So whether you are looking to day trade or you are looking to swing trade, technical analysis works in all time frames as well. I would like to ask you just one quick question. Who in here is day trading, and who in here is looking at this more from a swing trading perspective by the show of hands? Is anyone a day trader in here, or anyone a swing trader? I guess, it doesn't necessarily matter so much for today's presentation, but it just would be interesting to know if what your time frames are that you are focusing on. So, like I said before, really it works in all time frames, so it's really relevant as to what your focus is, but nonetheless, make sure you know which time frame you're focusing on before starting to trade stocks or any asset class for that matter. Next thing is that technical analysis can essentially be broken down into two different categories, for the lack of a better term. Number one, it's price indicators, things such as moving averages, trend lines, technical formations, Fibonacci analysis, and many other things. The second category, at least by my definition, technical analysis can be also broken down into something called momentum indicators. You have various different indicators in there, things like stochastics, this thing here, or MACD, which stands for moving average convergence divergence, the RSI, which is also known as the relative strength index, and many, many more. But really, essentially, we're looking at technical analysis that, broken down into price indicators and momentum indicators. We could arguably add the study of volume, which I did not put in here. Volume study is another study that people tend to add. Personally, for me, I am not a big favorite. I'm not a big practitioner of using volume analysis. That's not to say it doesn't work, but usually when I see an important move take place, that is being flagged as valid or high probability by price indicators. Usually then, well, all the time, I should say, I always check what the volume does as well. And the volume most of the time will tend to agree with price if the move in stocks, if the breakout or the reversal or whatever it is, and we'll look at all these things, is meaningful enough. Okay, so that's the two basic breakdowns as far as technical analysis is concerned. And again, you can, if you want to add volume study as a third potential way of looking at it. All right, so Fuad is stating that MACD is another way of a moving average. Well, the MACD is not a moving average itself. It's just telling you how far the moving averages are basically a part of each other. We will talk about this much more in a future webinar, so you'll see exactly what that is, and it's a pretty useful tool, I think, for sure. All right. Now, the other thing about technical analysis before we start looking at examples is that you want to start simple. I have seen too many people come in and start trading, and they start, coming in and using what I would consider fairly complicated analysis. So I think trading is best done if you have, a simple approach, because if you have a simple approach, that also means you have you can make it repeatable. Excuse me. If you don't have a repeatable approach, it's very difficult to make money in the stock market over time, and in any market for that matter, because what's going to happen is that you will start confusing yourself by trying something new every single day, every single week, every single month, or whatever the interval is in which you try new things. So if we sort of extend that line of thought into the world of technical analysis, and again, in this case, mostly focusing on stocks, then we will realize that what that really means for this is that starting very simple with simple moving averages or simple trend lines, is really a good way to start. Now, what I'm going to do is I'm going to give you a lot of examples over the next 35 minutes of stocks and indices that have in the past and potentially continue to act very well or react very well to technical analysis. So that is what we're going to focus on today. But again, before we even get into that, I want to make sure that at its very core, technical analysis can be used in all time frames, in all asset classes. And again, I think it's best to start very simple, using some simple moving averages and trend lines. Last but not least, and I'll talk about this much more in the next slides, and again in all the examples, is that you want to use technical analysis for purposes of reference, for reference points, and you'll see what I mean about this in just a minute here as we start looking at the stock charts. All in all, technical analysis works very, very well in the stock market. Again, we are focusing on US stocks here, and it really is a beautiful marriage. As you will see, and I'm going to show you guys all the examples right now, it just seems to work very well. And I think a major part of why it works so well is because the liquidity of the US stock market, because of the orderliness of the information flow, and because of the variety of market players, of institutions and individuals that partake in this market, and because it's not a 24-hour market, so if you're trading FX or currencies, you might find success in that. It's indeed a lot of people do. But one of the big drawbacks of currencies is that you can trade it 24/7, 24 hours a day. Some people think that's an advantage. I think that's a big disadvantage. And the reason for that is because the liquidity is not always the same, and there's so much news to digest that trading foreign exchange, unless you're day trading it, I think is a very, very difficult thing to do, just because of that very simple fact. But again, technical analysis will work very well in currency trading as well. So, what we're going to talk about today and over the next few webinars is stuff that you'll also be able to apply using the currency market. Okay, now let's go through a whole bunch of examples here, and we are going to divide up the examples in two ways over the next 35 minutes or so. Number one, we're going to be looking at examples of the major US stock indices, showing you charts of how technical analysis has worked in the past and how it's continuing to work well using these indices. I will go into much more detail on all of this, all of the different types of analysis in the future webinars, but I want to keep it very simple and straightforward today and just give you a lot of examples of, and so you can see that how well technical analysis works in the US stock market. Then we're going to look at individual stocks as well, and if you have some stocks you want to look at as well, we can do that too. We're going to do much more of that over the next few webinars as well. We're going to look at the major stocks today, stocks like Apple, Facebook, Amazon.com, NVIDIA, that's a hot stock this year, Bank of America, Netflix, Tesla, and many, many more that you may find interesting. Okay. So, having said that, let's start taking about 30-35 minutes or so and looking at the Roboforex platform and looking at examples of trades, or in the past how the US stock market has reacted very well to very basic technical analysis. So what I'm going to do here is I'm going to add one more moving average here. In fact, what I'll be doing is I'm going to add a 100 period moving average in blue. If that works, it should work. Yeah, let's do that. All right, perfect. So now what we have here, this is the S&P 500, and we're going to keep this very simple. What we're going to look at here is the S&P 500 using some very simple moving averages. And the moving averages I have here, I'll tell you in 1 second what they are. These are not the only ones. I'm not telling you these are the only ones you should use. I'm just using these as reference points because I find these are the most straightforward to use for reference points. And already, we're going to get into an important point here. So let's start very basic. Let's take about maybe 10 minutes analyzing the S&P 500 so you can see how well the S&P 500 itself reacts to various technical analysis. I'm trying to see here for the retracement. Okay, cool. And by the way, this is the Roboforex stocks trading platform. So if you are not yet using this, I would certainly encourage you to sign up for it. I think it's very straightforward. It's very good, and it's important that you use a platform for trading stocks or currencies or whatever you want to trade that is straightforward to use and that you don't lose oversight of. And I think this is a very good tool that does just that. So this is the S&P 500, and you can see essentially we're looking at the S&P 500 here. Looking back quite a bit of time. We're going to stick with the daily time frames for the most part here, just to keep things simple. Let's quickly play with this here for a minute. Let me see here. You can add. Yeah, that's good enough. We'll just use this. So this is the S&P 500 looking back a few years. In fact, this is the S&P 500 going back about, let's see, goes back about, 5 years or so, something like that. And if we look at it that way, you can see that really the S&P has reacted very nicely to its various moving averages here as we started coming out of the as we came out of the financial crisis that we had here in the United States and really around many parts of the world. And along all this way, you can see that, for example, the 100-day moving average, which is this blue line, has acted very nicely as support until it didn't, right? And then once again here, the blue line, the 100-day moving average, acted very well, right? Then the stock market broke below, and ultimately the 100-day moving average once again acted as support for some time, and then the market broke below it again, and then it became resistance until it broke back above it. And then the market stayed above it, and then it got a little bit choppy here in November, but now we are well back above it. So as far as the S&P 500 is concerned, a very simple rule that I have learned over the past 20 years is that you do not want to use the 50-day moving average. Okay, this is just a very simple simple rule of mine. The S&P 500 most of the time, and I don't say always, I say most, does not react well to its 50-day moving average. Technical analysis is a funny thing because stocks and indices and different asset classes they all have their own personalities. So if you think about this, the S&P 500 or any stock for that matter may react well to its 100-day moving average or its 200-day moving average or to various trend lines and other types of analysis, but it may not react well to different types of moving averages. So like for example, the S&P 500 here, it reacts very well to its 100-day moving average, and it tends to respect its 200-day moving average for the most part. But the 50-day moving average is completely useless. Again, for the most part, not always, but for the most part. So different stocks will react differently to different moving averages, and that also changes over time. So like I just said, the 50-day moving average most of the time is useless, but sometimes it's useful. Sometimes it works. Like for example here, look at this period. Just a little bit of time ago, the S&P 500 stayed very nicely below its 50-day moving average, and it acted as resistance all throughout this period here in September and October of this past year. So that's this period. You can see the yellow line is the 50-day moving average, and it acted as resistance. So just quickly to clear up any confusion that may be out there, the 50-day moving average is your yellow line. Then we have the blue line, which is the 100-day moving average. And then we have the red line, which is the 200-day moving average. Okay, so that's just a little bit about moving averages, and I will talk more about this going forward. But one of my very simple rules is I like to only buy stocks if they are trading above their 50 and 100-day moving averages for trades that last more than a few weeks. That's, in my opinion, usually a good thing to do. So if you look at this, for example, in this period here, you can see the S&P 500 started breaking above its 50-day moving average here. This is earlier this year in February. And then once it started breaking above its 100-day moving average, in my opinion, the odds for a multi-week trade or so, were pretty good to buy the S&P. That's, aside from the fact that you could have bought it down here. But once the stock trades, or in this case, the index or the ETF trades above both its 50 and 100-day moving average, again, that's the blue or the yellow and blue line respectively, in my opinion, there are better odds of the stock going higher. Just like now too, when we broke past after the election in November of this past year, the US election, you can see that at that point where my cursor is, the S&P 500 broke above both its 50 and 100-day moving averages and started to push higher. And at that point, if that was the only analysis that one did, one would have had a very good odds of buying the index for a trade to the upside. So let's quickly look at the S&P 500 and just give you a big picture idea so you can see how well the stock market reacts to just basic trend lines. So you can see that the S&P 500 had a very sharp incline over the years coming out of the 2009 depths of the financial crisis, and it continued to move higher and higher and higher and higher. Ultimately, the stock or the ETF or the index started to get very tired in the, let's call it, middle part of 2015. Maybe we call it early 2015, depending on how closely we look at that. And you can see that for the most part, the stock market started to just basically trade sideways. So we can look at this very simply. Let me just draw a very simple line here. See if I can do it this way. One second. Let's just use this one here. So you can see that really, for the most part, the S&P 500, largely speaking, traded in a defined range from May 2015 all the way through this past July. So just a few months ago, you can see that the S&P 500 was basically range bound. And so what happened in July is that the stock market, the US stock market, started breaking higher. So after a prolonged period of being stuck in a big picture range, the S&P 500 broke higher. You can see that, how it broke out of this. Let me just make this a little bit, there you go. You can see how it broke higher out of this big box, and then it retested. It actually broke back into this red box, but it found support at its 200-day moving average. Can you see that? That's the red line. And once we were down there, we had a very sharp up gap in early November. Actually, just before. Actually, this was on the elections, and that breakaway gap combined with, and we'll talk more about what breakaway gaps are in future webinars, but that breakaway gap combined with the 200-day moving average, combined with essentially what was a retest of the breakout, right, gave way to a very, very sharp, meaningful rally over the past, let's call it a month and a half or so after following the US elections. So you can see how nicely the S&P 500 reacts to technical analysis. We can look at this even a little bit closer, and again, I will teach you more and more about these different types of analysis we can use. But for example, here in June, we had the S&P 500 lows. Let me quickly show you guys. Look something. Let's see here. Let me draw the Fibonacci tool here, and I'm assuming that's going to work. All right. Oh, I see. Okay. So you may not be able to see this very clearly, but I will tell you right now. So if we use a very simple analysis, you can see these were the lows in the S&P 500 in February. And if we use a very simple Fibonacci retracement tool, which I will explain to you more what that is in future webinars. Again, the purpose of today's webinar is to show you how well US stocks react to technical analysis. And we then take this to the highs here in let's see here, we have to make this a little bit smaller. Let me read this again, guys. Sorry about that. Let's delete that. Okay, do it again. Have to be a little bit more. So we start here. We go here. So you can see that the S&P 500 retraced almost exactly 50% of this entire move higher, okay, of this move up. It then fell, or retraced is the technical term, almost 50% of that move, which coincided with a retest back to the 200-day moving average. So if I get rid of this Fibonacci channel, you'll see that, oops, where is this not going away? Yeah, okay. So you can see here that the 200-day moving average, which is the red line, the 200-day moving average was violated only for like not even a full day, okay? And the very next day, the S&P 500 was back above that 200-day moving average, which coincided with a 50% retracement of this entire move up and then back down. Okay, now this is why I told you one of the most important rules, in my opinion, for technical analysis is to use it as for reference points. Okay, I find that if you use technical analysis for specific entry and exit levels and ignoring the fact that there may be room for error, I think then it's very difficult to use technical analysis. But if you understand that we're using it mostly for reference points, then when the S&P 500 broke below its 200-day moving average here in June, which also coincided with a 50% retracement, then most likely you would have respected that. And when the price was back above the 200-day moving average, just one day later, you would have had a really good opportunity to actually buy this index using very straightforward technical analysis, which again, I will show you more in the next few webinars coming up. So that's the S&P 500, and you can see how it has ever since basically worked higher. Now, one more thing we need to talk about here is a very simple trend line. So the S&P 500 and most U.S. stocks, large cap U.S. stocks at least, for that matter, they led themselves very well for drawing what I would call very simple so-called trend lines. Okay, and these trend lines, for the most part, oops, let me let me get rid of some of these. And these trend lines, for the most part, can be drawn very simply, which is exactly what I like to do. So you can see, for example, if we have a simple trend line here, right? So once the S&P 500 started breaking above this trend line, right here in early November, or maybe the middle part of November, depending on how you look at it, at which point we also had the S&P 500 break back above its 50 and 100-day moving averages. Remember, I talked about that before. If you respected that and you saw that, you had even more reason to buy the index higher after that. So, one of the big things for me, and that's something that differentiates, my way of analysis from a lot of other folks, a lot of other people, is that I really like to focus on points of where you have the highest probability of making money in the stock market, or in any market for that matter, because really high probability opportunities in any market only happen every once in a while. So that's why another reason why I think the US stock market is very good to trade is because it gives you lots of different opportunities every single day in different stocks or different indices. But it's not going to give you a lot of opportunities in the same stock or the same index every single day, because that's unrealistic. That's also why a lot of people that trade foreign exchange, have a difficult time using technical analysis, because they're focusing on just one or two, maybe, or three currency pairs. And the reality is that you're not going to get a lot of high probability trades in the same currency every single week. For the most part, even if you're day trading, it's just how it is. The really good opportunities only happen every once in a while. All right, so that's the S&P 500. Let's talk about a few other stocks. Let's go and look at the shares of Apple, which, in full disclosure, right now, for me, actually looks pretty promising, looks pretty good as of right now. And of course, this is fairly irrelevant depending on when you might be looking at this webinar. But let's start very simply. And you can see that the shares of Apple have, for the most part, been trading in, let's call it, 4 different channels ever since this part here, back here in time. You can see there was a very well-defined trade channel to the downside. Then there was a channel to the upside, and then there was another one to the downside. I believe we used, I'm trying to think which tool I used for that. Doesn't matter. Then we had a downtrend, and now we're having another uptrend take place in shares of Apple. So that's point 1. So you can see we can very nicely define these movements in shares of Apple. Now, if we just get rid of these channels, or whatever I called them here, and just focus for a minute on just the moving averages, okay? Just again to keep the analysis unanimous from the way it was before, you would see that the red line, which is the 200-day moving average, has acted as a great indicator for shares of Apple. So when Apple broke below its 200-day moving average back here in time, it was sort of a last resort signal to get out of the stock, or maybe to short it, or to buy put options, or whatever you might like to do. Likewise, when Apple pushed back above its 200-day moving average, again, that's that red line back here at this point, you can see it then retested it and went on for a very, very big rally over time. Then it broke back below its 200-day moving average here, retested it as resistance, and then it dropped lower. And most recently, when it broke back above its 200-day moving average in August of 2016, which is right here, it then retested it again, and is now rallying to the upside. So you can see how some very simple moving averages and some very simple analysis can give us a lot of perspective using in the stock market, and how that could really help us pull out lots of profitable trades. Well, let's look at this a little bit differently as well. Let's start drawing a few simple trend lines using our Roboforex tool here. So if we just use a very simple trend line, you might see that shares of Apple, let me zoom in like this. Shares of Apple started breaking above the trend line and the 200-day moving average here at this point in time, which was, like I said before, I was basically this August or late July, depending on how closely you look. So the trend line also coincided with this break above the 200-day moving average. Then, and this is a really, really important point, then Apple stock retraced or retested back to the red line, the moving average, the 200-day moving average, and also, which also roughly coincided with a retest of this resistance line here, right? So again, you have to give technical analysis ample room for adjustment, or ample breathing room, and then it tends to work very, very well. But that's also why I said you want to use technical analysis for reference points and not for specific points in time, or very specific entry and exits, because sometimes that makes people too confused. You want to make sure you understand where the reward to risk is best using technical analysis for reference entry and reference exit points, but not to get married to those points. In other words, you have to respect them for what they are. I will show you more what that means. If that sounds a little bit confusing right now, that's not a problem. Okay, so again, here's shares of Apple, and you can see how nicely they retested the breakout. And that's a very classic way of technical analysis, which is what something you see a lot in the U.S. stock market. You see it a lot, where if you have a meaningful breakout, for example, in this we had a breakout past diagonal resistance and past the 200-day moving average. More often than not, if the breakout is important, you'll see it retest back to this point, and then it goes higher, right? So you'll see this in many examples that we're going to go through here today, and then in the next few webinars as well. You'll see that these retests are extremely powerful and extremely important through the lens of technical analysis, and that U.S. stocks tend to do that very well, which is why one of the reasons why they lend themselves so well to technical analysis. Let's look at shares of Facebook, and Facebook has also acted very well over time to technical analysis. In fact, if we start the analysis a few years back, one of the most important trades that I did over the past 10 years was trading the breakout in shares of Facebook. And the breakout was this line here. Okay, so let me zoom in a little bit more. And this breakout here, you can see this was the initial public offering in shares of Facebook. So when Facebook became a publicly traded company in the U.S. stock market. And then you can see how the how Facebook started falling and then it rallied, but it couldn't get past at this point in time here, so, or this price level, which was, again, that's this red horizontal line I just drew. But then at this point in time here, which was, I guess this was July of 2013 or so, you can see how Facebook had a really big breakaway gap. And this is, again, something we'll talk about more going forward. But you can see how that breakaway gap broke the stock above this horizontal resistance area. You can see that. And how that then led to a very meaningful rally that is still going on. Okay, so this very simple point in time, was so well respected by technical analysis, or so well depicted, that's probably the better way of saying it, by technical analysis, that really, if you follow this, it would have been one of the best trades you've done in your life, and it was one of the best trades for me to respect that breakaway, because I've been holding Facebook in one of my accounts ever since. So that gets us into a little bit of a closer analysis. You can see that Facebook, for the most part, since, well, let's call it at some point in early 2014, has been trading higher in a very well-defined channel. Okay, and you can see that the 100-day moving average, the 200-day moving average, which is the red line you can see on your screen here, has been acting as a very important source of support on a weekly closing basis and also on a multi-day closing basis. So you can see there was only 2 attempts over time here where shares of Facebook actually broke below the 200-day. In this case, I think this wasn't even a daily close. Yeah, this was an intraday break below it here, and here the break below it was only for one single day, so it wasn't a whole lot. Now it's getting more tricky. So right now, again, this is just for example purposes. You can see now the stock is holding below its 200-day moving average for, well, a few weeks here and there, but what's more important about that is that that's the first time the stock is doing this ever since this big breakaway that I just told you here back in 2013, I guess is when that was. So you can see, technical analysis does its job here. Every time the stock rallied to the upper end of its range, okay, you can see how that was respected each time it was faded. In other words, it was better to sell the stock for a break back to the lower end of the line. And also you can see that this entire time here, when the stock was going higher, or at least from once we could start drawing a channel like this, the 50-day moving average was for the most part trading above its 100-day moving average. So the 50-day in yellow, for the most part, was trading above the 100-day moving average. And I told you before that I like to only trade stocks or buy stocks through a multi-month lens if the stock is trading above the 50 and 100-day moving average, and the 50-day is trading above its 100-day moving average. So, and now you can see this is changing a little bit. So not only is the stock trading at the lower end of the range, it's also trading around and chopping back and forth around and a little bit below the 200-day moving average. But also, for the first time in years, the 50-day moving average, the yellow line, is breaking below the blue line, which is the 100-day moving average. And on top of that, you can see that both of those lines are now pointing down. You can see they're sloping lower, or at least the 50-day moving averages and the 100-day moving averages is starting to curl lower every single day. So that's, in my opinion, some sort of a concerning move. But the beautiful thing is, and again, this is why technical analysis works so well, because you can see we have very well-defined risk. So if Facebook starts breaking below this point here, and this is, again, just a timeless example, if Facebook, in my opinion, can hold and break below this area here, which we can quickly mark maybe with, maybe I can mark it here like this. If it breaks below this area, okay, then Facebook does look pretty bad. So So of course it has to do so. And like Fuad is saying exactly here correctly, we had a breakaway gap to the downside that took place here at this point in time just a couple months ago. That was a very concerning breakaway gap to the downside following the latest quarterly earnings in late October of this past year. So, or I guess it was early November, I think is when it was. So anyway, so you can see, and I hope you're starting to see how well technical analysis, or how US stocks, how well they react to technical analysis, and how you might be able to make money from this if you just study this a little bit. It's really mostly a matter of sticking to your risk management plan. Okay. So let's look at one more stock here. We're almost out of time for today, but let's look at one more stock. And maybe, let's see, you were asking some questions here. So someone's looking at Tiffany's, which is, of course, a big jewelry retailer. So let's look at Tiffany, for example, if you want to look at that. So number one, let's note, again, the 200-day moving average. And again, just to stress, the 200-day moving average and all these moving averages will react differently to different stocks and vice versa. But you can see in this case, the red line, again, that's the 200-day moving average. For the most part, it's been a pretty good tell. For the most part, if the stock is trading above its 200-day moving average, it tends to bounce off of it as support. For the most part, it doesn't always happen. You know, when you have turning points and things get choppy, you need to start taking things into smaller time frames, which is something we'll talk about going forward. And then for the most part, when there's a downtrend, you can see the stock will trade below it's a downsloping 200-day moving average. And now we're back above it again. You can see that Facebook, shares of Tiffany broke back above its 200-day moving average just, let's see, when was that? That was back in August. It then retested it. You can see classically, very, very nice move. See, broke above its 200-day moving average, retested it as the 50 and 100-day moving averages crossed over each other, and then started pushing to the upside. So you can see how well this works. In my opinion, right now, the stock still looks okay. I would wait for a bullish reversal, which is something I'll cover in more detail in future webinars here for Roboforex. So that's a good example. And here too, you can see very nicely how Tiffany's also had a situation where we could draw a very simple trend line like this, right? And you can see that when we drew that trend line, not only at this point in time did Tiffany's break above its 200-day moving average, again, that's the red moving average, but it also broke above its trend line. And then it started finding as support, which also coincided with the 50-day moving average and the 50-day moving average crossing above its 100-day moving average, okay? And going higher. Ever since then, the 50-day moving average is held as support, and if the 50-day moving average now breaks as support, then the next area of support should be the 100-day moving average. At least that's the way I look at it. Those are the moving averages I use for reference points. And after that, it would be the 200-day moving average again. Okay. All right. Lastly, let's look at one more stock here. This is Apollo Group, a stock that I haven't looked at in some time because it's been in a bit of a house of pain. You know, again, keep in mind I'm not giving stock tips here, but I probably wouldn't be. It's actually not a good example because I think Apollo Group was actually being, didn't it get purchased or something? I seem to recall something like that. Anyway, it doesn't matter. Let's look at shares of Amazon.com just to round out today's presentation. To round out today's presentation on the different tickers. So Amazon.com, you can see here, let's get rid of this quickly. Also a stock that reacts very, very well technically. Let's just focus on, for example, what has happened over the past 12 months or so. And you can see that the stock here, for the most part, when it starts breaking above resistance like that, Let me move in closer. You can see it starts breaking above resistance, which is this red horizontal. It then retested it and went higher, right? We then mean reverted back down to this area, and now we're consolidating. So now, for the most part, the Amazon.com is consolidating and waiting potentially for a move following its upcoming earnings announcement. So, you can see also how the 50-day moving average acted as support very nicely until the stock started breaking below it, in which case it became resistance, right? Also note how the 50-day moving average pierced above its 100-day moving average. The 200-day moving average, for the most part, held as support, except for a few days here, which I think on the weekly chart it actually held as support, or barely. So again, these are all stocks that react very well technically, and so I'm hoping this lesson today was helping you see how well U.S. stocks react to technical analysis, and how I would encourage anyone to use technical analysis on U.S. stocks for any time frame of trading, really. So we will wrap it up here. We will go through many more examples of stocks and how well they react, and all sorts of things like that going forward, including ABC. I know you had questions on a couple stocks there. I would like to cover that a little bit later on. Again, keep in mind it's not so much giving you an immediate trade idea gratification, rather than what I'm trying to do in this series of webinars is to teach you how to trade U.S. stocks and how you can learn how to trade U.S. stocks. I will show you more also about my indicator that I have. It's my own proprietary indicator, and various other types of educational material that we have available as well. So with that, I thank you for attending. I wish everyone a good rest of the day, and hope to see you back here next time for another webinar. Let's see, one more question. Fuad was asking, can MT5 be used for trading stocks? And I don't know what MT5 is. I do not know what that is. But I'm sure you could send a question to the good people at MetaTrader. Okay. MetaTrader, I have no idea. I honestly don't know. I would highly encourage you to use the Roboforex platform. That's what I would encourage you to do. So that would be my exactly, stock.roboforex.com. That's what I would encourage you to do. So, all right, guys, thank you so much, and I will see you next time.